You've probably seen videos that say, follow the smart money, read the volume, print money. And it sounds great, but nobody tells you the part where you're right about the direction and still lose money on your leaps. That happened to me. And today, I'm going to show you why and how to actually think about volume when you're trading long-dated options. Let's start with something basic. LEAPS are just options with expiration dates really far out, usually a year or more. The idea is simple. You believe a stock is going to move significantly over the next 6 to 12 months. Instead of buying shares, you buy a LEAPS call or put. Less capital, more leverage. Sounds clean, right? But here's what beginners don't realize. Even if you're correct about the direction of the stock, 3 other things can quietly destroy your trade. We'll get to those in a minute. First, let's talk about volume, because it genuinely matters. Just not in the magical way most people describe it. What volume actually tells you. When you look at a price chart, you're seeing what happened. Volume shows you how much conviction was behind it. Think of it like this. If 10 people show up to an auction and 1 item sells, that's low conviction. If 10,000 people show up and that same item sells at 3x the price, that's high conviction. Volume works the same way. High volume on a big move means a lot of participants agreed on that price. Low volume on a big move means not many people were behind it. And as a LEAPS trader thinking in months, not minutes, that distinction matters. Because you want to be positioned in stocks where real, sustained interest is building, not a one-day spike that fades by Thursday. The 3 phases. Here's a simple framework for reading volume over time. Phase 1. Accumulation. This phase looks boring on a chart. Price is moving sideways. Volume is elevated, but nothing dramatic is happening. What's going on underneath? Large participants, funds, institutions, are quietly building positions. They don't want the price to run up while they're still buying. So they buy slowly, patiently, over weeks sometimes. For you as a LEAPS trader, this phase is worth paying attention to. It's not a signal to immediately buy. It's a signal to start watching. One honest caveat here: institutions increasingly use dark pools and algorithmic execution specifically to hide their activity. So what you see on a standard volume chart isn't the full picture. It's a clue, not a confirmation. Phase 2. Confirmation. Eventually price breaks out, and this time volume expands clearly with it. Strong candles, increasing participation, follow through over multiple days. This is where the move becomes more credible. For LEAPS, this is a reasonable zone to consider entering, because you have evidence that momentum is building, not just a rumor or a single candle. But, and this is important, don't enter just because price went up and volume was high on one day. Look for consistency across several sessions. Phase 3. Exhaustion. This one is critical to understand. It looks like the best time to buy. Huge volume, big green candles, news everywhere, social media going crazy. But this is often where large participants are exiting, selling into the excitement that retail buyers are creating. Price can keep going. Sometimes it does. But statistically, entering during full public euphoria is one of the riskiest times to open a new LEAPS position. If you're already in, great. Think about trimming. If you're not in yet, be very careful. The part most videos skip. Okay, here's where we get honest. Let's say you read the volume perfectly. You spot accumulation. You wait for confirmation. You buy your LEAPS call 6 months out. And the stock goes sideways for 2 months, then slowly grinds up. You could still lose money. Here's why. Risk number 1. Theta. Time decay. Options lose value every single day just from time passing. This is called theta. Even if the stock doesn't move at all, Your option is worth less tomorrow than it is today. With LEAPS, theta is slower than short-dated options, but it's still real. If the stock takes too long to make its move, theta is quietly eating into your position the whole time. Risk number 2, implied volatility crush. This one surprises a lot of beginners. When you buy a LEAPS option, part of what you're paying for is implied volatility, the market's expectation of how much the stock will move. When a stock has an earnings announcement coming, IV goes up. Options get more expensive. Then earnings happen. Even if results are great, IV collapses. And your option loses value, even if the stock went the direction you predicted. This is called IV crush, and it has ended a lot of otherwise correct trades. The lesson: pay attention to when you're buying, not just why. Entering right before a major catalyst with elevated IV is expensive and risky. Practical framework. So how do you put this all together as a beginner? Here's a simple process. Step 1. Check the trend on the weekly chart. Is the stock in a clear uptrend or downtrend? Volume analysis works best when you're trading with the larger trend, not against it. Step 2. Look for accumulation zones. Sideways price action with elevated volume near key support levels. This is your watch list, not your buy list. Step 3. Wait for confirmation. A breakout with expanding volume over multiple sessions. Now you have something to act on. Step 4. Check implied volatility before you buy. Look at the IV rank or IV percentile for the stock. If it's unusually high, you're overpaying for the option. If it's low or average, the timing is better. Step 5. Give yourself enough time. When buying LEAPS, go further out than you think you need to. If you think the move happens in 3 months, buy 9 months. Theta and timing uncertainty are your enemies. Time is your buffer. Volume is a real and useful tool. It tells you something meaningful about who was active in the market and how much conviction was behind a move. But it's one piece of a bigger puzzle. And if you're trading LEAPS, long-dated options where timing, volatility, and patience all matter, you need to understand what can go wrong even when you're right. The traders who last aren't the ones who found a perfect system. They're the ones who understood the risks, managed them honestly, and stayed in the game long enough to learn. Start there. If you want to see a follow-up on how to check implied volatility before buying a LEAPS option, let me know in the comments. I'll see you in the next one.